Adobe stock has crashed over 30% in the last year, but is this a golden buying opportunity or the start of a slow decline? With AI disrupting everything from graphic design to video editing, is Adobe about to become the next blockbuster, or is Wall Street overreacting? Let's break it down. Welcome friends to the channel. Today we're going to be talking about Adobe, so let's just go straight in. Adobe is one of the biggest companies out there with a market cap of $190 billion and it has a PE ratio of 35. It has a very low debt, $6 billion of debt on a $190 billion company, very low, and it has a price to sales ratio of 9 times. It's a profitable business with growing revenues every single year and it has margins of between 25 to 30%. They have 3 major segments. You've got the digital media side of things, you've got the digital experience side of things, and you've got the publishing and advertising side of things. Going on their website, you could see all of their products. There's 94 results in total, and you've probably heard of a lot of these apps yourselves. So you've got the apps such as Acrobat, you've got Photoshop, Premiere Pro, Illustrator, Adobe Stock, and Adobe Firefly, one of their new apps. So it's a huge business, as you can see. And going straight into the numbers, having a look on the Finviz website, you could see that so far the stock is looking very promising. Earnings per share has been going up the last few years. The revenue every single year has been going up. The outstanding shares, they've been buying back their shares. So these are all good signs so far. Having a look closer at the numbers, the PE ratio is 35. On its own, this means nothing. We have to compare where it's been before and we have to compare it against the sector, and we'll do that later in the video as well. Forward PE of 19. They have a PEG ratio of 3. This is on the higher side and it does indicate that the company is overvalued, but again we'll explore this as we go down. It has a price to sales ratio of about 9. It has a quick and current ratio of greater than 1. So this company has enough assets to cover its liabilities. Other numbers that are important: over the last 5 years they've increased their sales by 14% every single year. Over the last year alone they've increased their sales by 11%, and the last quarter alone another 11%. So it's looking really promising at the moment. They have a gross profit margin of 88%, which is crazy, and once you factor in taxes and other expenses, their net profit is 25%, which is really good for this type of company. Breaking down the revenue further, majority of the revenue comes from the digital media side of things like Photoshop, etc. Every year this has been growing a lot. The other sectors, such as the digital experience and the publishing, they've been increasing as well, but not as much as the digital media has been increasing. I mentioned looking at the PE ratio alone, the price to sales ratio alone, it doesn't really mean much. You have to look at it in comparison to where it's been in the past. So you could see over the last 3 years, the average PE has been 43 for Adobe. Currently, we're trading at a PE of 35, and it's also 22% lower than where it has been over the last 5 years. So just looking at the PE ratio alone, Adobe is trading cheaper than where it has been. When you move on to the price to sales ratio, the average for the last 3 years has been 11, and currently we are at almost 9. The lower the price to sales ratio, the cheaper the company is trading at, which is really good. When compared to the 5-year average, Adobe is almost 30% cheaper. Same goes with the price to book ratio. Lower is better, and currently they are trading 12% cheaper than where it has been 5 years ago. We can also look at the price to free cash flow ratio, and you could see Adobe is almost 30% cheaper than where it has been over the last 5 years. So by looking at all of these metrics, Adobe is definitely trading cheaper than where it has been over the last 5 years. But is this justified? Is this worth it? Is there a reason for it? That's what we'll uncover in this video. Let's have a look at the total revenue Adobe makes from subscriptions. Since 2015, this has been going up, and it's a steady trend. This is really promising to see because you could see they are making more and more every single year, and that's what you call a compounding machine. We can also look at how much free cash flow this company is getting per share. That has also been increasing since 2015. There's been a bit of a dip in 2023. The overall trend is up, and it made up in 2024. Also, having a look at the EBITDA margin of Adobe as well, that's also in a steady trend up. This company is efficient, is making more money every single year, is generating more free cash flow. They're buying back their shares, they're rewarding shareholders. Since 2015, Adobe has been in a steady uptrend. For majority of the time, Adobe has been trading above the 200-week moving average. However, you could see right now, Adobe is trading below the 200-week moving average. There's not been many times in history where Adobe has been trading below the 200-week moving average. There was a phase in 2022 to 2023 where it was trading below the 200-week moving average, and there was also phases in the past in 2008 to 2011 where it's been trading below the 200-week moving average. Other than that, majority of the life of this company has been over the 200-week moving average. So it's very interesting where it is right now. And when compared to the S&P 500, you could see year to date is currently down 1%, whereas the S&P 500 is up. Over the last year, Adobe's down 30%, whereas the S&P 500 is up 21%. And over the last 5 years, Adobe has underperformed the S&P 500. But when looking at the max chart, you could see Adobe has been doing much better than the S&P 500. And this is better seen on the Adobe divided by the S&P 500 chart. Just a quick explanation of this chart. If the chart is trending down, that means Adobe is not outperforming the S&P 500. If the chart is trending up, that means Adobe is outperforming the S&P 500, and if the chart is flat sideways, that means Adobe is in line with whatever the S&P 500 is doing. So if S&P 500 is going up, so is Adobe. If S&P 500 is going down, so is Adobe. And having a look at the long-term chart of Adobe from the year 2000, the overall trend you could say is something like this, is up. So you could see over time, S&P 500 has been outperforming the S&P 500. It's just in the last 5 years or so, the overall trend since 2019 has been more so in this direction. So it has been underperforming the S&P 500. What does that actually mean in terms of price? When looking simply at technicals, you could potentially see a head and shoulders being played out over here. So you could see the left shoulder here, the head here, and the right shoulder here. And you could do a measured move. And if this measured move plays out, then Adobe might still go down about 28% versus the S&P 500. I know it's hard to chart this sort of thing. However, a 28% drop from current price of Adobe would bring it down to about $315. But that's not the same as saying 28% against the S&P 500, but it's just there as an illustration anyway. And if it does go down to $315, that would be close to the lows of 2022. And that brings me on to the risk for Adobe. There are two major risks with Adobe. The first risk people talk about is the risk of AI taking over things like Photoshop, etc. Photoshop is one of the staple apps that Adobe is known for. And the question is, will AI take over something like Photoshop or some of the other apps that Adobe have? And while it might be tempting to say yes, that's possible, one thing you need to take into consideration is the wide economic moat that Adobe has. And you can imagine that once a company, an institution is actually using Adobe, it's very hard to move away from Adobe. Think of your workplace using apps such as Adobe Acrobat Reader or Photoshop. It's very difficult, the switching cost for them to move to another software, whether it be AI or Canva or whatever it is. It's very expensive for them to do that because they have to sort out a new subscription elsewhere. You've got the cost to actually change over the software, hiring the technicians to make that happen. You've got the cost of training the staff on the new software, and then you've got the ongoing maintenance of the software. Whereas for the companies that already have Adobe, they've already been through that process. They know how Adobe works and they've been using it for years and years. So it's easy to just stick with Adobe because that's what their staff know. They don't want to go through the hassle of switching just to save a bit of extra money because to them it might not make sense. So that's one thing to take into account. And staying on that topic, Adobe has made something called Adobe Firefly. This is their own AI solution where you can integrate AI into Adobe programs. So with this, it's all in one system. I was having a listen to the earnings call and AI was one of the concerns mentioned in the call. Adobe, their response is they know the threat of AI and they are working to integrate AI into their programs. The second concern is over the last few years, Adobe has been growing 10%, and over the next couple of years, Adobe is poised to grow another 10% per year as well. This is really good. However, the question comes, where is this actual revenue coming from? Are they getting it from new subscribers or are they getting it from their existing clients by just hiking the prices? And if you look at the Adobe website, they've been increasing their prices every single year, and the price increases that they are doing amounts to about 10% every single year. So just by having a look at this, it seems as though the 10% revenue increase that Adobe are making is from their existing customers by just increasing the prices 10% every single year rather than new subscribers. From their earnings call, they have been claiming they have been getting new subscribers. However, it's hard to verify these sort of things because they don't actually have a number of subscribers listed on their earnings calls or anything like that. So it's very difficult to predict. But just based on these numbers, if they are increasing their subscription cost by 10% a year, then it seems as though their revenue increase is matching that. And that's good whilst the customer pays. But the question is, has the actual subscription growth stalled out then? Is there a chance that it can decrease over time? And the second question from that is, at what point do customers say, okay, every single year my subscription is increasing 10% a year? At what point do customers say, this is too much now, I can't afford this, I need to look elsewhere? And when that does happen, Adobe might see an outflow of customers, and they might then start dropping their revenue, and they might miss on their targets, and this can have an even more negative impact on their company. So what's my final thoughts on Adobe? My final thoughts on Adobe is currently trading way cheaper than it has been over the last 5 years. It's trading at a lower PE ratio, a lower price to sales ratio, a lower price to book ratio, a lower price to free cash flow ratio, and even when compared to some of the other big technology companies, it's got a low price to sales ratio compared to most of the others, not all of them. It's got a low forward PE compared to most of these companies. It's got a low PEG ratio compared to most of the others. It's got a high operating margin compared to most of the others. And it's got a very stable 14% compound annual growth rate over the last 5 years as well. The forward enterprise value over sales is low as well compared to the others. I think Adobe is definitely undervalued here. And a large portion of the sell-off over the last few years has been because of the threat of AI and Adobe. You could see when ChatGPT started becoming mainstream, the price of Adobe has just been tanking. Although it did rebound then, it is starting to come back down. And whilst I did make the prediction that, maybe Adobe still has another 28% to go down, there's no guarantee that Adobe will go that low. And I think at the current valuation at $440, it is a very reasonable price to start buying Adobe. And that's exactly what I did. I started buying Adobe at $445. That was somewhere around here when they last had their earnings and it went down. And that was my entry price. And yes, there's a risk that Adobe might continue going down. However, every time I am going 5 to 10% down, I will be adding to my position. Adobe is currently rated 4 stars by Morningstar. It has a wide economic moat. It has a fair value estimate of $590 and it's currently trading at $438. It is much cheaper what the analysts are saying, and this company is severely undervalued. I've mentioned some of the risk associated with this company. However, I think those risks is more of an overreaction by Wall Street. And I think you should have a plan regardless, because waiting for it to go down to $315 is very difficult to say whether that will happen or not unless there's a recession or so. Buying at current prices and DCAing or buying every 5 to 10% dip, I think is very reasonable because it's already been beaten down a lot. So that concludes this video. If you found it useful, please like, subscribe and share with others. And if you haven't already, watch some of my other videos where I have gone through some of the other stocks such as AMD, Uber and what I'm doing with them. Soon I'll be sharing my portfolio so you could see exactly what stocks I own, and every time I do buy something I will mention it on YouTube and giving my rationale as to why I'm buying it as well. If you found it useful, please like, subscribe and share with others.